Okay, good afternoon, ladies and gentlemen. Welcome back to this weekly market review. We had a very explosive week last week on the stock market, and as usual, today I have my co-host here, Mr. Gerald Wong, joining us. How's your week, Gerald?
Well, Sunny, like you said, it was an explosive week for the market. We saw strong gains across different equity markets as a result of different macro as well as corporate developments. So we will definitely go through some of these developments during today's weekly market review. But at the same time, in Singapore, we also have a lot of things going on. For example, we have the Corporate Governance Week that is now ongoing. And I think, Sunny, you were at the launch yesterday.
Yes, I was at the launch of the Corporate Governance Weeks organized by SIAS yesterday. So for this week, SIAS is organizing our annual Corporate Governance Weeks from 6 to 10 November. And we have local and global thought leaders that will discuss issue on navigating legal, ethical, and social challenges, as well as key pillar of strengthening corporate governance with a series of conference and forums lined up. And on 10 November, this Friday, we will be having our virtual investor forum addressing ESG and climate governance insights for investors. So do look out for that virtual session happening this Friday. And if you want, you can sign up for that on our SIAS website. And then I will pass it to Gerald to let him cover all the explosive things that happened last week in the markets.
Well, so in case you're wondering, the reason why this week's weekly market review is on a Tuesday rather than on a Monday was really because of all of these ongoing activities around the Corporate Governance Week. Okay, but apart from that, we have quite a number of things to update the viewers during today's weekly market review. As usual, whatever is shared today is for information purposes only and should not be taken to be financial advice. So apart from the weekly market review, if you want to be asking Sunny and I more in-depth questions, do join the SIAS session that is happening on 15th of November. This session is for members of SIAS only. And if you are interested to join SIAS as a member, this is how you can potentially join SIAS as a member for only $12 per year or $1 per month. Okay, so go to this website or scan the QR code to be able to find out more details. Okay, so what we saw last week is that the US market had its best performing week this year. Quite rarely that you see benchmark indices actually up by 5% in a single week, but that was exactly what we saw in the US last week. So the S&P 500 was up by 5.9%, NASDAQ 6.6%. You might not see such big movements in the Singapore market, where the STI was up by 2.7%, but still a very credible performance. So what was driving this very strong rebound in the equity markets? It was down to just one thing, which was really around the Fed meeting last week. Okay, so that is what we will go through over the next few slides around what happened during the Fed meeting that led to such a strong rebound. Okay, so first and foremost, we saw that the Fed kept the benchmark rate unchanged, so keeping it at 5.25 to 5.5%. This was already widely expected by investors, but effectively what investors gain confidence through the Fed meeting is that the Fed is effectively almost done with raising interest rates. Okay, so that was really the key message that investors took away from the Fed meeting, which actually led to a very strong rebound in the stock market. Okay, so how has this actually translated into bond yields? Okay, we start with the US 10-year government bond yield. Okay, one of the reasons that the Fed actually shared in terms of why they are proceeding more cautiously is because of the fact that the US government bond yield has already gone up very significantly. So if you look at the 10-year government bond yield, we shared earlier that at some point in the past month, it actually exceeded 5%. And that would represent the highest level since 2007. Okay, so this was sometime last month. And with the very high long-term bond yields, the Fed feels that this will already have a dampening effect to the economy, which is why they are now proceeding a bit more cautiously. Okay, so what you see here is a very steep decline in the 10-year government bond yield. From above 5%, it actually went down to below 4.6% after the Fed meeting. You see this very series of sharp drops over a few consecutive days. And that is really driving increased investor optimism towards the stock market. Okay, so this is something that we'll continue to keep a close lookout for, as it will continue to drive how the stock market performs. Okay, so we have seen the 10-year government bond yield. If you're looking at something that is a bit shorter term, and what the market typically looks at to reference what the Fed activity in terms of interest rate would be, they will look at the 2-year government bond yield. Once again, we see this very sharp decline in the past week. Not as much as what we saw for the 10-year government bond yield, but still a very sharp drop. Okay, so that is once again driving investor optimism towards risk assets, including equities. Okay, so earlier we shared that investors have gained confidence that the Fed is done with raising interest rates. That is what we see in terms of the investor expectations around interest rates in the coming month. Okay, so based on the CME Fed Watch 2, no further rate hikes expected for the rest of this year as well as in 2024. And expectation is that the first rate cut could potentially come through in June next year. Okay, so that is effectively what investors have taken away from the latest Fed meeting that is driving optimism. Okay, so how has that translated to the Singapore stock market performance? We have seen very strong rebound in the STI earlier. And if I were to look at the top performers, we actually saw some of the STI component stocks gaining as much as 10% in just 1 week. Okay, so Fraser's Logistics and Commercial Trust up by 9.9%, CapitaLand Ascendas REIT 7.6%. So as a whole, we see that some of the REITs actually saw a very strong rebound as the bond yield started to come down and the concerns about their borrowing costs actually starts to ease. Apart from that, we also saw CapitaLand Investment up 6%, Venture up 6%, and DFI Retail Group also up by 6%. Okay. We went through Venture a few weeks ago as to how the stock actually offers a steady dividend payout. So that might be one of the reasons that Venture has seen a strong rebound in the past week as well. Okay, so in the past few weeks, we actually had some weeks where we didn't actually have sufficient top performers. So this week is actually the opposite. There were no losers within the STI in the past week, which is why I had to change the header of this slide to STI worst performers, when actually there were a few stocks that still saw gains, but were already the worst performers within the STI. Okay, so if I were to look at this chart, Genting Singapore was up by 0.6%, DBS up by 0.5%, and then you've got ThaiBev, Imperador, and Seatrium that were flat in the past week, and trailing the other stocks within the STI. If I were to look at some of them, ThaiBev and Imperador are consumer staple stocks, which are typically seen as more defensive stock, which is why they may have lagged the general market rally. And DBS, if you recall last week, there were announcements around how they were impacted by the recent outages. And also, generally, the banks are seen as potential losers if the Fed were to stop raising the interest rates, which is why DBS underperformed the STI in the past week. Okay, so in terms of the key movers, we saw very strong performance across a number of REITs. We also saw that a number of REITs reported their operational updates, which is what we'll go through during today's session. So number one, CapitaLand Ascendas REIT, one of the names that we often get asked about, saw that the occupancy rate remained stable at 94.5% in the latest quarter. We saw very strong gains by Keppel Infrastructure Trust, also one name that was very much talked about last week after they paid out a special distribution of 2.33 cents per unit. Last but not least, we saw Digital Core REIT announcing that it has reached a definitive agreement to sell some of its US assets. as well as having a number of agreements to be able to resolve the bankruptcy of its second largest customer. Okay, so this actually led to quite strong movements within this REITs, even though the REITs as a whole outperformed the market last week. Okay, so we start with CapitaLand Ascendas REIT. You see this very strong bounce from a low of about 250 up to now about 275 per share. Okay, so what is driving this rebound apart from the gains that we saw within REITs? The company also provided the latest operational update, and investors probably took relief that the occupancy rate as well as the rental reversions continued to be healthy. Okay, so if I were to look at the occupancy rate, 94.5%, not too different from where it was on the 30th of June 2023. But more importantly, if you were to look at the rental reversions, then it was a positive portfolio rental reversions of 10.2%. Okay, so the assets that it has continues to do well as reflected by the occupancy rate as well as the rental reversion rates. Okay, so if we were to look at CapitaLand Ascendas REIT in terms of valuation now, about 1.2 times price to book. This is slightly higher than the historical average price to book. And this might be one of the things that investors look at in terms of valuation in deciding whether this is a good REIT to be holding on, given that we have quite a number of different REITs that are actually trading at fairly low price to book compared to the historical valuation. Okay, next we have Digital Core REIT. We also see this very sharp rebound in the past week from about 50 cents up to 56 cents. So once again, like what we saw for CapitaLand Ascendas REIT, a very strong rebound with the lower bond yields as well as the operational update. So what did Digital Core REIT actually share with the market in the past week? Quite a number of different initiatives, which I will go through in detail. So first and foremost, a comprehensive customer bankruptcy resolution. Remember that one of its key customers was facing issues around its financial position earlier. So they managed to come up with a resolution around that. Together with that, with the sale of some of its assets in the US, it will be actually recycling this capital to be able to redeploy to acquire a stake in an asset in Frankfurt, as well as making an initial entry into Asia through taking a stake in a data center asset in Japan. Okay, so quite a number of different initiatives actually announced, and that is probably something that investors were more positive on as a result. Okay, so first and foremost, we look at what was being done around its second largest customer that actually faced a bankruptcy issue. So we saw that some of the leases were amended, some were terminated, and at the same time, they managed to divest some of the assets. If you look at the assets that were divested, effectively, this would bring in about 160 million of gross proceeds through the two assets that were being sold. Okay, so this is probably something that investors like because of the fact that you are able to resolve one of the concerns that investors have around the REIT. At the same time, you have got more proceeds that you can then redeploy into other users. So what will Digital Core REIT use these proceeds for? Effectively, two assets, one in Frankfurt and one in Osaka. And these are assets with occupancy rate of 92% in the case of Frankfurt and 95% in the case of Osaka. Okay, so that is one of the ways that Digital Core REIT will be redeploying the capital to be able to drive distributions for unit holders. Okay, so earlier we saw the price to book valuation of CapitaLand Ascendas REIT. If we were to look at it for Digital Core REIT, with the slight bounce that we saw last week, it is now back to about 0.7 times price to book, still below the historical average price to book since it was listed of about 0.8 times. Okay, so that is Digital Core REIT, one of the names that also a lot of investors have been asking about. And last but not least, we come to Capital Infrastructure Trust, another REIT or business trust that we saw this a very V-shaped recovery last week. And once again, this was driven by the announcement that Capital Infrastructure Trust actually did around its distributions. Okay, so effectively a special distribution of 2.33 cents. This is driven by the value creation strategy on top of the third quarter distribution of 0.97 cents, driven by the portfolio performance. So with this, the 9 months distribution per unit would come up to 5.23 cents, which is a 82.5% increase compared to the previous year. Okay, so a very sharp increase in distributions through the first 9 months of this year, which is driving the very strong recovery in terms of the share price of Capital Infrastructure Trust. Okay, so what is driving this improvement in distributions and allowing KIT to be able to pay out the special distributions? So effectively, that is driven by several new acquisitions as well as value creation within the existing assets. So if you to look at one of the assets, IZOM as an example, which was an asset that acquired in February 2019, you actually saw an increase in the EBITDA of 52% between 2019 and FY 2023. Okay, so that actually allowed the company to be able to grow the distributions and pay out more to unit holders. Within the existing portfolio, if you were to look at City Energy, also saw very strong EBITDA growth from 2021 to 2022. So once again, allowing the KIT to be able to grow its distributions and pay out more to unit holders. Okay, so with that, we have gone through 3 REITs and business trusts that did well in the past week. If you look at what is coming out in the week ahead, still very busy in terms of the earnings season in Singapore. We have got SIA reporting today on the 7th of November. We have got the Singapore 6-month T-bill auction that has been brought forward slightly this week because of the upcoming holiday next week. And then at the same time, we continue to see a number of blue chip names reporting their earnings, with Singtel on Thursday, 9th of November, and OCBC on Friday, 10th of November. So a very busy week in terms of the Singapore reporting season this week. At the same time, we also have a lot of developments in the US market. And with that, I'll hand over to Sunny, who will share with us what are some of the key things to be looking out for.
Hey, thanks, Gerald, for breaking down the good news that was happening last week and cautioning us or telling us what to look out for in the coming weeks. So I will do a quick roundup on some of the major indices, and we will touch on the first one, which is the SCI index. So we spoke about the SCI index for a couple of weeks, and we said that the support region is somewhere around here, this orange color highlighted line. We broke this, and then we already tested the year-to-date low in March. Okay, so I remember 2 weeks back, Gerald was asking me how market is tanking already during the bull run where we met. So I said, don't worry, I think market is likely going to bounce up. Why was that the call? Because below this year-to-date low, we can actually see that the low, if it go to the next support level, would actually be the previous year low of around the June level. Okay, so this was the low that we are looking at after we break the year-to-date low this year. So at that level, we see that there is some kind of a support coming in for the SCI index, and we do get a bounce from that level. So from there, we have seen last week, the last 5 trading sessions in the previous week, we can see massive rebound from the SCI index. However, on Tuesday, we see that today STI is in the red. Why is that so? It's because of this downtrend line. If you connect the year-to-date high of this year together with the high in September, you will see a downtrend kind of formation with a series of lower highs. And that was also confirmed or giving us a signal that during the October period where the index starts to go up above this red color downtrend line, it was pushed back down again. So this time round on today, Tuesday, we see that we are at the level again to retest this downtrend line. So I think that is the first reason why we are seeing the red candle that we are seeing today. So it's not a surprise that we are seeing a bit of the market holding back. So is this the resistance level now to watch? Will we have a breakout further upwards? That one we will have to wait for more data or more indication to come out to reflect that. But however, I'd like to take note that the indicators, regardless whether it's the MACD or the RSI, is still showing a pretty strong kind of a momentum or positive sign. You can see from the MACD histogram that the green color bar is still expanding upwards, meaning that momentum is still strong. And the RSI is above the 50-point neutral mark, now reading at 57. So we are still quite some points away from the 17-point overbought level. So there is still healthy momentum and there's still room to grow. However, even if that really happens, the next major resistance level will come in at this red color line over here. And if you look at the right-hand side of my screen over here, that is the exponential moving average line, which is the 200 days. So 200 days exponential moving average will really be a strong resistance level for the STI index to break, even if it breaks the recent downtrend line from the year-to-date high, connecting the high in September. So I think the upside now for the STI in the near term is likely going to be limited. So testing this line now, the downtrend line, investors take some profit off, and even if we may have a second leg of a upward drive, it will likely test the 200 days moving average, and then the rightly might just at least pause there, and then after that we would reassess the situation and see how it goes from there. So if you have taken a long position from the support level around the year-to-date low over this period over here, then probably when it hits the 200 days exponential moving average, you will want to consider to take some profit off the table. Or even right now, we are seeing some of the investors also taking, or maybe taking half of their profit off the table for the long position since the bounce. So do look out for that. Okay, the resistance level, the next resistance level that we are looking at is the 200 days exponential moving average at around the 3,211 points level. Next, I'll move to the major US indices. So first, let's touch on the Dow Jones Index. So as Gerald mentioned, the single most important news that happened last week was the Fed pausing the interest rate again and then holding the rates at between the 5.25% to the 5.5% level. We've seen the Dow Jones Index actually rocket upward as well. And we are now at the previous high somewhere in the 17th of October period. I will just put a line over there. Okay, so this is the level about 34,147. So from last Friday closing of 34,095 points, we are about 50 points away from the high that we saw in October. Okay, and above this red color line was the high that we saw in this period in the May of this year. So likely around here, we would see a little bit of resistance coming in. So this week, we foresee some resistance or a pausing of the uptrend that we see last week on the Dow Jones Index at least. Okay, so all of the information or all of the upside from the Fed announcement, I think, has been priced in right now. And going forward, we really be looking for new catalysts to decide where we want to go or where the market will be going. If not, I think this resistance level of 34,147 or 34,281 would likely be the resistance level that the Dow Jones Index will be pausing the rally that we see last week. So we are about 150 points to 100 points away from the resistance level. Indicators wise, they are still looking positive. So that's why there's still a bit of a breathing space to push up a slightly higher, about 100 points, before we see that the RSI starts to get closer to the 70-point overbought mark. And that is where we have to exercise more caution to prepare for a potential retracement backwards down to the 20 days moving average at least. Next, let's move to the S&P 500. We have that similar bounce, and the previous high in October, on 17th October, we see at the 4,393 points level. I'll just round it up to 4,400 points level. So last Friday, close of 4,365 points. We are about 40 to 50 points away from the 4,400 level, where we will test the October resistance level. Above this, we have a bit of a double top formation somewhere during the June period of this year on the S&P 500. So that will be the next resistance level to watch out for. And looking at both the indicators are still positive, and the RSI at 58 above the 50-point marks, meaning that there's a positive momentum, still below the 60-point marks of very strong momentum and below the 70-point mark of oversold level. So there's some room to grow, but once it tests the 4,400 level, that is where we have to give the S&P 500 index extra scrutiny to see that whether we still have legs to run it up to test the year-to-date high. Okay, if not this level over here, 4,448 points, or even the upper bound of that Bollinger Band at 4,444 points would likely be the resistance level you need to watch out for the S&P 500. Lastly, let's move to the tech-heavy Nasdaq Composite Index. Okay, the best index performer, I believe, for last week. Last week jump among the 3 major US indices. So we closed at 13,518 points, and the October high that we observed was around 13,714 points. So we are 200 points away from the October high. And above that, the other resistance level to watch out for will be the double top that you see over here in the June to July period. That is around the level of 13,864. So this level also coincides with the upper bound of that Bollinger Band right now at 13,864. So likely a lot of technical indicators or a lot of technical chart levels are saying that this is the resistance level. So do watch out for this level, 13,860 point level. That is where the major resistance, I believe, will come in for the Nasdaq Composite Index. Looking at the MACD indicator, still positive because we have not reached that major resistance level. RSI is also positive, pretty strong as well, and have not reached the overbought level of 70. So we still have some room to grow for the 3 major US indices, as well as the STI index a little bit more. So I think we do need to watch out for right now on the markets is if you have already taken a long position in the previous 1 or 2 weeks, it may be good to practice some conservative actions now to take some profit off the table to wait for a pullback towards the mean or even the 20 days moving average before we think of what is the action we need to do next. So this is trading. We have to constantly look at the market and how the market moves. Let's say market is overexerted, we need to practice and take some profit off the table and then reassess the situation to see whether we are still on track on our trading thesis or the rationale that we have entered the trade earlier. So that is all I have for this week weekly market review on the analysis of the major indices. Gerald, any last words?
Sorry, Sunny, can you repeat that?
Yeah. Okay. Hi, Gerald. Any last words after my coverage of the indices review?
Okay, so I think we saw that we have already a very strong bounce in the US market, but still quite a number of earnings yet to be reported. And then at the same time, there are different macro indicators that we're still continuing to look out for, including the strength of the US jobs number, how inflation data continues to come through in the coming weeks, as an indication for us to really understand whether the Fed is really done with hiking the interest rates. But in the meantime, we have the corporate governance week that is ongoing. So do join us in this event, and we'll continue to update you in the weekly market review as to how these different indicators are actually tracking.
Okay, thanks for the reminder. So just repeating what we said earlier, this is the corporate governance weeks of SIAS, and Friday we have the investor forum, which is a virtual session. The registration is still open for you to sign up, so you can look out for our SIAS website, sias.org.sg, to find out more information. If you would like to sign up, if you have any questions, you can also email us at admin@sias.org.sg. So with that, we have come to the end of this weekly market review. As usual, I want to thank Gerald for joining me today. And his name is Gerald Wong. My name is Sunny. So we will be signing off, and we'll see you again next week in the next weekly market review.